If you are watching this, you've likely hit a milestone that 99% of the world dreams of. You have liquidity. Maybe you've just sold a business, exited a startup, or perhaps years of disciplined saving abroad has finally compounded into that magic number $1 million or more in investable cash. First, congratulations. That is the hard part. But here is the dangerous part, the part nobody tells you. That cash, if it's sitting in a bank account, or worse, trapped in low-yield real estate, it is technically lazy capital. You have worked hard for your money, but your money isn't working hard for you. I am Kunal from EPK Capital. For over 20 years, we've helped families not just get rich, but build wealth that lasts for generations. Today, I'm going to walk you through how to build a dividend portfolio from scratch. But I'm not going to give you a list of hot stocks to buy today and sell tomorrow. I'm going to show you the architecture of a portfolio that pays for your lifestyle without touching your principal. And specifically, for my NRI friends, I'm going to show you why your current strategy might be costing you huge in taxes and missed growth. Let's start with the biggest mistake I see high net worth individuals make. I call it the yield trap. You look at a stock screener. You see a company, let's call it Company X, paying a massive 10% or 12% dividend yield. You do the math. $1 million invested here gives me $120,000 a year. That's $10,000 a month. I'm set. Stop. This is the fastest way to destroy wealth. In the world of dividends, an abnormally high yield is usually a scream for help, not a gift. It often means the stock price has crashed because the business is dying, but the dividend hasn't been cut yet. Think of it like this. Buying a high-yield stock is often like buying a cow that gives 20 liters of milk today but is sick and might pass away next week. At EPK Capital, we don't chase yield. We chase sustainability. We look for the Dividend Aristocrats, companies that have raised their dividends for 25, 40, or 50 years straight. They might only pay 3% today, but that 3% is safe, and more importantly, it's growing. The second mistake is specific to my NRI clients. It's called home bias. You love India. I love India. It's the fastest growing large economy in the world. But many of you have 90% of your wealth in Indian real estate or fixed deposits. Here is the reality check. Indian rental yields are typically 2% to 3%. Indian fixed deposits? They barely beat real inflation after tax. And then, there's the silent thief, currency depreciation. If the rupee depreciates against the dollar or euro by 3% a year, your Indian returns are being eaten alive in global terms. To build a true passive income fortress, you need geography diversification. You need the growth of India, absolutely. But you also need the stability of the US and global markets. You need companies like Johnson & Johnson or Procter & Gamble that pay dividends in hard currency, USD, protecting your global purchasing power. But Kunal, what about taxes? I hear you ask, won't I get taxed twice? This is where sophisticated planning comes in. India has double taxation avoidance agreements, DTA, with the US and many other nations. If structured correctly, you don't pay double tax. You pay the tax in the source country, and you claim a credit in your residence country. Do not let the fear of paperwork stop you from global diversification. That is what firms like ours handle. The third mistake, thinking about income instead of growth. If you retire today with $100,000 a year in passive income, that feels great. But in 10 years, thanks to inflation, that $100,000 will only buy $70,000 worth of goods. If you buy a bond, your income is flat forever. But if you buy a dividend growth stock, your income rises. Let me give you a real example. Warren Buffett invested in Coca-Cola in the late 80s. Back then, the yield was decent. Today, because Coca-Cola has raised its dividend every single year, Buffett is earning a 50% yield on his original cost every single year. That is the power of yield on cost. We don't want to just pay your bills today. We want to pay for your grandkids' education in 20 years. That requires companies that can raise prices and pass those profits to you. So, how do we build this at EPK Capital? We use the Moat and Math approach. The moat: we only buy companies with an unfair advantage, a monopoly, a brand, or technology that competitors cannot touch. The math: we look at payout ratios. If a company earns $100 and pays out $90 in dividends, that's risky. We like companies that pay out $50 and reinvest the other $50 to grow. The allocation: we blend high growth Indian dividends with stable, hard currency global aristocrats. This creates a portfolio that is resilient. When one market is down, the other stabilizes you. When inflation hits, your paycheck goes up. Building a portfolio like this isn't about day trading. It's not about watching the news every morning in a panic. It is about architecture. It is about sleeping well at night knowing your wealth is working harder than you are. If you are sitting on significant liquid capital, 1 million US dollars or more, and you're tired of lazy returns or worrying about currency risk, let's have a conversation. I'm not asking for your money. I'm offering a perspective. Let's review your current allocation. Let's see if your portfolio is built for 2026 or if it's still stuck in 1996. Click the link in the description or visit us at EPK Capital. I'm Kunal. Thank you for watching.